the topic of mistakes. So another question I had was because you stay away from, I think you mentioned in previous podcasts and previous, I think in your blogs as well, that the three things that you mainly stay away from are businesses with bad management, businesses that use leverage or debt, and then businesses that are in an industry or companies that are basically in secular decline.
Hmm.
So, are there any other warning signs that repel you away from the company? And my follow-up question to that is, so what were your biggest mistakes where you actually buyed the companies that weren't inherently good and had these red flags or signs?
No, it's a great question. So there are three sources of trouble that I identified over the years, and I keep a list of companies that I've owned, companies that I looked at, companies that I was intrigued by. I even keep a list of companies that I would never own, but I think they would be an amazing case study of what can go wrong. And I shared it in some of the articles. Now, those three groups, as you mentioned, bad management, too much debt, and secular decline. The funny thing is that sometimes those three things happen at the same time. You have an industry that's going through so much change that it can't produce the growth that it used to. And it's a tricky place to be because as a value investor, somebody that's looking for a bargain, you might end up in that segment of the market and not realize that it's not just a cyclical or a temporary slowdown. This industry is going through a massive change. And I think we'll see more of that going forward because of innovation and because of it's a bigger topic. But when we spoke about profit pools, a lot of the biggest profit pools these days are in broadly defined tech companies. Different institutions that label sectors, they move companies around, and companies that used to be tech, now they're called different things. But any company that's heavily relying on technology, whether they're selling ad space or they're selling smartphones, it's all at the end of the day, a technology company, and they're subject to change, much faster change than we've seen before. If you're thinking about chewing gum that Buffett quotes quite a bit, not much has changed in the way we chew gum. He's right, but even in that part of the market, people are chewing less gum. And I think in some places, and I believe Singapore is one of those places, there are some big fines if you leave the chewing gum where it doesn't belong. Am I right?
It's actually banned here now, so you can't chew gum.
There you go.
Yeah.
It's yeah. It's even you have the government tell you you can't chew gum. But anyways, it's fascinating how the businesses are subject to change. So it's a spot that I try to avoid. You mentioned companies with a lot of debt. So that's debt allows you to look really smart when things are going the right way. And you, as a business, let's say, you have the equity, the capital, but then you can use leverage. And when you use leverage and you grow only, 5 or 10% with leverage on that equity, the returns that you get are very high. So you look like a genius. But you also have to remember that leverage works both ways and people so easily forget it. And when things are not going as well, your dip in profits is not going to be just the 5%, but it could be 50% because of the leverage that you use. And sometimes the cut is so deep that the business is put in a position where it can fail to survive and go bankrupt. I'm actually putting together a little article about bankruptcies. In my life, I owned tickets of 3 airlines that went bankrupt. And the first airline, I held the ticket when I was a graduate student in Paris. And it was about the time I was planning to meet Francois Sicard, who's my business partner, who was at the time soon to become my mentor and first boss. And we've worked together for 20 years managing family fortunes. And the airline went bust and I lost my ticket as a student, and my student budget was not so big. So I really felt the loss. It made me think a lot about how do companies go bankrupt, right? If you have a company with no debt, with nice margins, profits, with a loyal customer base, and fairly honest management that tells you how things are, this company will not go bankrupt. A company that will go bankrupt is a company that borrowed too much money and eventually uses the bankruptcy laws to liquidate its operations or find another way to continue to operate by negotiating with the debt holders and so on. Not getting too technical about it, but basically debt can get you in trouble in the sense that you as a shareholder could end up with something that's worth zero. And I have this philosophy that you might have seen in my articles and the books, that I have a no zero policy. I don't want to buy anything that could be a potential zero. And it's just a certain mindset that I have. It takes me away from big parts of the market, including companies with a lot of debt. Now, the management, I think it's one of the hardest things to evaluate. And I like to listen to earnings calls, read transcripts, read annual reports, and just see how are you speaking to me as a shareholder, but also as a customer, and how are you treating everybody? And I was in meetings where the numbers looked great. I couldn't find anything wrong. And would walk out from the meeting. And on a human level, we were talking about behavior, but on a human, psychological, emotional level, I felt very uncomfortable with the people that I just met. And I'm all about numbers and I see the scientific and technical side to investing, but there are moments where your intuition kicks in and it's something that's harder to pinpoint and quantify. And you might even come across that kind of experience when you're listening to somebody and you can tell that there's something not unauthentic about them and you can't tell what it is. But the beauty of investing is that you can walk away and choose not to buy just because you personally don't feel comfortable being a part of this business operation as a shareholder. And I think it's something that maybe comes with time. Some maybe people have a gift and can tell, but you can realize that these are just not the people you want to be in business with. And that particular company a few years down the road had restatements, accounting issues. The CEO was fired. So at the moment, I couldn't tell what's going on, but over time, other people eventually resurfaced issues with this particular business. But that's something to think about. The bigger question that you're asking, I would call it, what is it that I avoid? And I avoid anything that doesn't make sense to me. So when you think about what you're looking for, and if you're looking for, as I am, for the profit streams and profit pools out there, whichever image speaks more to you, then anything that has no profit, like a cryptocurrency, is not something I'm interested in. So these are parts of the market that I completely avoided. The way SPACs were offered, SPAC is not a new invention, but the way they were used in 2021 to raise money and then to chase investments, to overpay for them, and then so on. And anything that becomes an overheated and too exciting part of the market, I completely avoid. Now you have a lot of businesses that have failed economics, unit economics. So you have a business where somebody loses money on every square foot they rent or every used car they sell. Now, there is a difference between being a younger company that's still growing and that's still developing its business model, as you know very well, and a company that's been around for a while and still fails to deliver positive unit economics. So if they're losing money on every unit they sell, it's as if you're giving away $100 bills for $50. How fast can you grow giving away $100 bill for $50, running around Singapore, tomorrow morning? Unlimited amount of money, right? So if you're getting bigger and losing even more money, eventually your shareholders will say enough. And that happened to many companies in the last few years where the market basically told them your business model doesn't work and you've been trying and it doesn't work. And the stock market might be very forgiving for a brief period of time, especially when there's a lot of euphoria and enthusiasm, but eventually the market says, this is not a real business and we will not continue participating in it. So I think of it as having the freedom to avoid big parts of the market that don't make sense to me. And I like to think of quality of sleep. If I was to hold something and I wouldn't be able to sleep well holding it, it's an immediate no for me. Now, when you're managing money for other people, you have to take into account, and I think it takes an unlimited empathy to take into account other people's emotions. So you might be a very well versed investor and analyst with all the understanding of the business, but for whatever reason, your clients don't feel comfortable with you holding that particular investment. That's something that's worth taking into account. Because at the end of the day, they entrusted you their lifetime of savings, their inheritance, money that they received through some wealth event of a sale of a business, and you have to take that into account. And if they don't sleep well, there's no point in holding on to that investment.
Yeah, that's very true. I think, of course, I don't have any experience, but from what I've read, I feel like when you're managing other people's money, it gets I think you try to be more aware about the sleeping well part because you do realize that this is not just me anymore. Because if I make a mistake now, a lot of people are gonna get affected. And from just that perspective, I think you feel more.
I had Guy Spear on my podcast, and it's a wonderful conversation. And the moment that I really remember from this conversation is when he shared with me when he started managing his father's money. And he said he was shaking because he felt the responsibility that he had for a family fortune. And there's a big difference between managing your own money and learning and growing with that experience than managing your family money or your friends' money and then opening up and managing clients' money. And I think it's another dimension that the investor can continue to grow. It's not just getting better at picking stocks or making it through bear and bull markets and finding opportunities, but taking into account that you're responsible for somebody else's money. And it's something that I was not taught at school. I think it came from experience and actually sitting across the table with somebody. And I think it's one of the most rewarding, but also one of the hardest aspects of being a professional investor, where you have to take into account how other people feel. And I mentioned in my articles that people think that the bear markets are hard because the stocks are down and there are some paper losses to talk about. But I think it's the bull markets that are the hardest because this is the moment where your neighbor is getting richer than you. And somehow it really gets to people. And I want to ask you a question because in your book, you share a myth, an Egyptian myth that you might remember about envy between siblings. And envy is as old as humankind. And actually, Charlie Munger said it's not greed, but it's envy that gets people in trouble in the markets. Can you share with the audience that myth, if you remember it, and the idea of envy?
Yeah, so I think the myth is that uh, there is Osiris and Set. Um, they are two Egyptian gods. They're I think siblings in Egyptian mythology. And then Osiris gets I think a really beautiful wife, and he marries her, and then the two of them live happily. But Seth, seeing this, gets really unhappy because he didn't have a happy life, but his brother did. So with that, he kills his own brother out of the envy that um, I didn't have what he has, and that I want the same thing, and I want to be better than my brother. And this eventually leads to, I think, um, him also getting even more miserable
Mm-hmm.
because also says is her wife uh, hated Seth after that. And then after that, the two brothers had fierce rivalries. They both, their entire relationship collapsed because of the jealousy and the envy that Seth had. So that is I think it's a fable in Egyptian mythology, and
Mm-hmm.
it's a very good idea because I think most ancient stories, mythologies, fables, sort of have this idea that there is some things are inherently bad when you're making decisions. For example, envy. So this is, I think, the mythology, if I remember correctly, the story. Yeah,
No, it's a wonderful story, and it reminds us that envy is just part of the human experience, and in the markets, well, in life in general, I think envy can get you in trouble, but definitely in moments of great excitement in the market where you see other people get richer faster than you, that's
yeah,
something that gets you in trouble.
and I think a part of that is also the fact that we've evolved to, I think, cater to other people's emotions and to be like other people, especially when they're doing good. So if you were in your caveman times and you didn't listen to when everybody else was doing something, then you would not be well off. You probably wouldn't even exist. So so we're wired in the way to follow, I think, the crowd, to follow the herd, and to also, when someone does something better than you, you have that spirit in you. I want to beat him, and I think
Hmm?
that's where a lot of problems also arise in the world. Not just investing.
It's very true.
Yeah. So I think so in your book, Outsmarting the Crowd, uh,
Yes.
you did talk about this herding and social proof and how this mindset really affects us when we're making decisions as individuals and I think as a collective society as well. But
Hmm.
so how can we as investors realize that we have this um, bias in our minds and it's influencing our decisions? So what are the questions that we could ask to, prevent such a such a thing from actually being in our mental state or mind?
So, as you mentioned, on an evolutionary level, there's safety in being part of a larger group because for most of our history as a species, we've lived in large groups. And it was helpful to follow what the group wanted. You didn't want to be excluded from the tribe. And in some cases, your survival was at stake if you were excluded from the tribe. So if everybody was saying that Bitcoin is a good idea and you're the only one that says Bitcoin is a bad idea, do you think you'll be invited to dinner when the next hunt happens? But William Green, in his book Richer, Wiser, Happier, writes about one of many things that great investors have in common is that willingness to be alone or to be lonely. And he mentions some quotes of Chris Davis, who is one of the successful investors, how among value investors, you don't find too many people that like team sports. There are people that play tennis or golf or they swim or they bicycle, but not many people that participate in basketball or football or soccer. And I think it's a certain mindset that those investors feel very comfortable being alone. And what I mentioned earlier is creating a certain environment where you give yourself a chance to hear what would you think if nobody else told you what to think. And these days, when you open your phone, I have all the notifications off and I don't see the daily headlines. When I choose to, I'll check them, but I don't have them pushed to me. But in 5 minutes, you have so many opinions from other people. It's a recession. It's not a recession. Interest rates will go up. No, they will go down. Inflation is heating up. No, it's over. So you hear so many different voices and they start to cancel each other out. And the beauty of the crowd is that if you have large enough of a group, and there are studies that I mentioned in the book about, weighing a bull, and you ask everybody in the square in a town. I mean, imagine Middle Ages in Europe, and there's a big bull on the stage, and they ask everybody write down how much that bull weighs, and they've done studies since that if you have a large, diversified, independent thinking group of individuals that are not just influenced by what the person next to them is thinking, right? It's very important that they have their own opinion. You could end up with a fairly accurate estimate of how many pieces of candy are in the jar or how much does the bull weigh. So there is a certain wisdom to what the crowd can conclude from the information they collected, that you have to have them all with an individual opinion. I had Daniel Crosby, who is a psychologist, on my show, and he said how if you have people individually make a decision, the decision is fairly accurate. But if you put them in a group where they start to communicate and get influenced by each other, so it's a group thing that I talk about in my book, Outsmarting the Crowd and Money, Life, Family as well, then it's an opinion of a group and you want to stay part of that tribe, you end up going with most of the people. And that decision that's influenced by a smaller group and everybody starts to think alike might not be as accurate. And that's what happens in the markets where you have the madness of the crowd. And there are books written about it. It's not a new phenomenon, but the stock market is this small, big lab where you can have people vote with their money. And if everybody wants to buy Tesla or everybody wants to buy Nvidia or whatever it is at a given point in time, then you can have a very crowded, single-minded way of looking at things. And obviously, you can push up an individual stock to the levels of madness. There's a story, an anecdote of Sir Isaac Newton, who had many roles, not just a physicist, but he was a treasurer. He actually also invested in the markets, and there was a bubble of his era, the South Sea Company, and he made money initially, left the market, and then came back because he saw his friends get richer than he was. And when you think of somebody like him, who I imagine being a very rational, very scientific, very logical, and very disciplined, something happens when you introduce the market, and something happens when you introduce a daily quote. And a crazy thing happens when you remember that we can be envious of other people getting richer faster than us. People call it greed, but I think Munger is onto something, and you're onto something with the myth and the fable that you shared. That envy can get us in trouble in those moments. So I think the big lesson is benefit from the crowd when it pays to do so. So if you're choosing a restaurant, if you're choosing a book, if a lot of people liked it, it's fairly likely that you might like it. And there are moments when it pays to disagree with the crowd. And that's where you can make a bigger difference in your investing journey, where you buy when others panic. The fear and greed that Buffett talks about, be fearful when others are greedy, be greedy when others are fearful. So we'd mentioned ownership of stocks, right, as something beneficial in your lifetime. And I think you'll do just fine investing a little bit over a lifetime, but you can do even better if you choose to invest more in moments when others panic. And I'm not talking about just the whole market, but individual stocks go through their own ups and downs. There might be a delayed product launch, a product recall, a management change, missed earnings that bring the stocks down. I mentioned it in one of the interviews how it's very curious to look at the 52-week range of any particular stock that you might like. So let's say you and I are talking and you end up liking some company, a very successful, I don't know, retailer or a tech company, and just out of curiosity, look at the price range that this company had, the stock price of that company had over the last 52 weeks. I think a lot of us, I'm always surprised what a wide range it is. And obviously, the last few years have been unusual, but even over a normal period, more normal period of time without a pandemic and so on, you would notice that the same stock could be trading somewhere between $20 and $40. And I always wondered, what would it take for me to be able to pinpoint that moment when it's a $20 stock? And I call it down cheap, out of favor moments, where a good quality business for some reason is down cheap and out of favor. And these are the moments that you can act just because you've been watching it and you know that you like it and you wanted to own it. And that's the moment when you can buy more of it and make an even bigger difference in your end result.
Yeah, I think that's a it's a very true thing. I think Joel Greenblatt, he also talks about it in his book that
Mm-hmm.
in his if he's going for a course, or if he's teaching people at a university, the first thing he asks them is to look at the stock price on a 52-week high and a 52-week low. And even
Hmm.
companies um that are meant to be companies that remain stable and they don't really fluctuate a lot. For example, General Motors at that period of time, or General Electric, or utility-based companies, even with them, they I think they can be as high as $120, and then a few weeks later they can be trading as low as $30 a share, $40 a share. So just in 1 year, you can see such a digression, or such a gap from the mean, which he.
And and if you keep showing up every day or regularly and keeping an eye on the businesses you want to buy, you might have an opportunity to buy more at a lower price. I want to highlight the difference between the private market and the public market, and some of the audience might be familiar with the big difference between the two. But if your goal is to own businesses over a lifetime, you could be buying them in the private market. So walking around your town or your city and buying a share of a laundromat or a fast food franchise or a car wash or whatever it is that's available. You could be doing that, or you could be buying larger companies, a wholesaler, a distributor in your region or in your province or in your state, all the way to buying shares in Amazon, who publicly traded and has been around for a while now. But the difference between the private and the public, there are many, but one big one is that the public market offers a daily price quote. So if you go to a private owner of a car wash in your town, very popular, it's on the corner, great location, you can see the volumes are great. Even if your own research shows that this business has to be doing very well, and people love it and they feel like they get great value. So you want to get 10% of that business. You walk over to that owner who probably has family member also involved. They've been running it for a while. Maybe it's been in the family for a while. And you say, I want to buy 10%. The price that they will offer, it will be a fairly full price, or maybe even a premium price, because they don't really want to part with 10% of a good cash flow business that maybe they want to keep in the family. They really have to have a reason to sell you that business. And they have no motivation or limited motivation unless somebody in the family doesn't want to take over the business, then maybe they would sell it. So you have to have so much more context to have an opportunity to buy, and the price you'll get will probably be a full price. It doesn't mean that it will be a bad investment. Just be aware that it will be a fairly full price that you'll pay. Now, in the public market, because you have this anonymous participation of a crowd of buyers and sellers with a whole variety of knowledge and understanding of what is it that they trade or buy and own, and also a very different time horizon. Some of them might be holding the shares until the market close. You have some high frequency traders that hold shares for shorter than it takes a hummingbird to move its wings, which happens these days with some of those participants in the market, all the way to a foundation or a family trust that's buying those shares with an intention to never sell those shares again. So you have a whole variety of participants. And in that market, because of that crowd mentality that we talked about, there are moments that both the price can go way beyond what's full and fair or intrinsic, and it can go way below that because of the crowd's vote. And that's something that you will not see in the private market as much. You will see a distressed seller in the public market. The crowd as a whole can get very distressed in moments of panic. But if you have a private market distressed seller of a car wash, you might be asking yourself, why is that seller distressed? Maybe they're building a mall, as supermarket next to it, and the location will not be as favorable. There's something happening that will undermine the future of the cash flows. So that distressed seller is not a distressed seller you want to be talking to. But in the public market, the distressed seller is distressed only because of an emotional turmoil they're going through. It has sometimes nothing to do with the actual business. So that's something I wanted to highlight.
Yeah, that's. I mean, I think when you have a majority of people voting on a particular thing, you get a very good sense of how the company how people perceive the company may not necessarily be how the company is. It is their perception of it. And the funny thing is, the people that don't believe in efficient market, they believe in the efficient market and those kind of things. They believe that okay, one day it can be trading at say half the price is trading tomorrow, which makes absolutely no sense. Just because a news came or something that's not related to the business, intrinsically or fundamentally popped up, and that's because I think it also makes a sort of a loop because when people kind of feel that oh I did this oh this news came up, this seems to be stuff that's going to go to the moon, and then they go buy it, and then they see everyone else doing the same thing, so they're like let me buy more of it, and it just leads to this fallacy. I really think, um,
Mhm.
and for the idea that a lot of this is noise, um, a lot of business news is whether they are news about the economy, the macro conditions, or about the micro conditions, the specific business operating environments, or some down period for a short period of time. How do you tend to identify when it's actually a bad business news that could harm it, and when it's actually just noise because the line is a bit blurry sometimes.
Well, there are many ways to look at it. We have interns now and then with us, and they get excited about some of the stocks they're working on, and they bring me a piece of news and they say, "Oh, this is really bad." And I make them pause for a second and I say, "What makes you think it's bad?" Well, let's say, "Well, because the stock went down 5% on that news." And I said, "But you are a buyer, right? You want to buy more shares of this company. So what you were about to buy just became 5% cheaper. Is that good or bad?" And it becomes much more nuanced to them. When then they start to look at the news and they start to see, does this impact the business in a permanent way? Is this news something that has damaged the business in a way that we can't recover from? And I think that's the way to look at it. What kind of an impact that what we just heard has on the actual business, or it has only impact on the sentiment. I like to look when you talk about news, and the filter that you have or that I use. How long did it take to produce that kind of content? And these days, it takes a moment to tweet and reach tens of thousands, if not millions, of people. If you tweet the right thing that seems to be shareable and resonates with a lot of
Yeah.
people. Sometimes it's a funny picture of a pet. And if something took a moment to create, I have a very different attitude towards it than something that took a while to produce. And when you think about it, and I think it was Nick Sleep that William Green talks about quite a bit, and Guy Spear was inspired by, and who talks about the long shelf life of an idea. And I think others also talk about it in various ways and label it in different ways. But basically, whatever piece of information or data or any finding that you have, how long did it take to produce it? How long will it stay valid? And if I asked you and you told me this is really bad news, and I would say, if we meet in 5 years, do you think you will even remember this headline that you just quoted to me? And it makes you really think about it. And you might say, yes, this is really going to change this business for better or for worse. Or you might say, no, I don't think I'll even remember this conversation. And I think it's a good filter to have. Like, is this something that is relevant for the long run? When you look at not just the media, but a lot of investment meetings, I had Steve Clapham on the show, who is a seasoned hedge fund analyst, and he mentioned how a lot of meetings that he was a part of was spent on a discussion if the interest rates are about to go up or go down. Not just recently, but throughout his multi-decade career. And I told him, Steve, think about it for a second. If you know that so many investors spend so much time talking about something that's so short lived, which he points out himself, then anybody that's not wasting that half an hour, and sometimes even more time on that discussion, what an advantage it is, right?
Yeah.
Go for a walk, listen to music, or read a book, or do something else in that time. But you free up your brain. We talked about it, how your brain mental capacity is limited, but you free it up in that moment to do something else and not worry about the rates going up or down. I mean, Buffett sometimes jokes that if somebody whispered to him if the rates will go up and down, it wouldn't make a difference in what he's trying to accomplish, which is to find quality businesses he can hold for the long run. So think of it this way: whatever you hear out there, who said it? What's their intention? How long did it take to write it? Will it be something that I will remember 5 years from now? And if it's still there and it's still on your mind, maybe it's worth investigating. But I think the bigger question that you ask is, where do good investment ideas come from? And it's never been a headline in a newspaper for me, or somebody writing up a profile in a major financial magazine that I realized, oh, I never looked at this company. It's more the approach that Buffett has, and he had the Moody's manual where you had a one pager of companies, and he would go through them one page at a time. That was obviously before the internet and before all the tools that we have today. But if you're new to investing and you want to start somewhere, and you want to pick stocks instead of passively participating in the success of the economy, which is just fine with me, I think it's a great path. Then go down the list, whether you go from the largest to smallest or from A to Z. Go one company at a time. And I've done it, and I keep doing it because new companies keep showing up. And these days, I've seen and I've looked at most of the companies I could potentially be interested in. And if something new goes public, I look it up, I read about it, and I'm curious to find out what's this business about. And I'm trying to understand how the business operates. Would I ever own it? So any new company, I just want to be familiar with it. And sometimes it's a 5 minute experience, and sometimes it's a longer experience where I want to get to know it. But I have some sort of an opinion about most companies that I could potentially be interested in, and absolutely no opinion about companies I immediately rejected because of unit economics, because of high leverage, or because of the management, or other reasons. So think of it this way, as just the learning process and being able to find out what is it that you want to own. And when the headline happens, the headline is just an invitation for you to go back to what we talked about, which is the 52-week range or a 5-year range. The stock that you followed for a while and that you know very well, for some reason, because of some silly short-lived headline, is now available at a 52-week low. Well, maybe it's an invitation to look at it because you already know it. That's how I look at it.
I think Peter Lynch said, I think in one of his speeches, that if you spent, I think, 13 minutes in your entire year talking about the market and interest rates and inflation, you wasted 10 minutes of your life. Um,
Mm-hmm.
so he says that, and then I think another very true thing is that sometimes you don't need. I think we feel like we have to have an opinion on everything. We have to be giving our views aggressively and fighting for them. But for some things, I think it's better if you just take the popcorn and watch the story play out instead of
Mm-hmm.
having to participate in it. Because
It's
you can, yeah.
no, it's very true. And I think we all find, and you talk about the circle of competence. What is the area that you feel that you can have some advantage in? And that circle of competence will change over time. So I imagine that, even Buffett grew and changed his entire investment style through the decades. And I think anybody, you and I, will continue to grow and change. So allow yourself to expand. But being honest with yourself, back to what I mentioned with selective ignorance, the parts of the market and the parts of the news world that you just choose not to participate in. be kind to your brain, you know? That's how I look at it.
Yeah, because it is really mentally daunting as well. So I think Steve Jobs or someone, I think the reason he used to wear the same clothes every day was because he didn't
Hmm.
want to waste his brain energy on choosing his clothes as well. So
Hmm.
that's such a small thing when it comes to stocks. This is like a huge thing. We spend so much time on irrelevant stuff that um, when you get focused on the minutes of things, you tend to forget that there's a bigger picture that's available. And I think that's
No,
a big
absolutely.
mistake.
Absolutely. And I think over time you develop those habits like Steve Jobs of wearing the same thing. But in the investment world, maybe never owning a certain sector, for example, that you don't feel comfortable owning, maybe never investing outside of your own country, or maybe investing everywhere else but your country, right? So you choose your own your own formula and see what really works for you. The beauty of investing is, and I was talking to William Green on my podcast about Guy Spear and Monish Babrai, and I'm sure you know all of them, but that they're friends and they're close and they talk and they share the same principles. They had lunch with Warren Buffett. They come to Omaha together. I saw both of them in Omaha this year. I think you ran into them as well. And they have a very different way of looking at investments and a very different tolerance for risk. So the beauty of investing is that you can be close friends with a lot of fellow value investors if you're looking for one label, although I don't think it encompasses everything that we're trying to do. But in that group, you will have people that follow the same principles, but express it in different ways. And looping it back to the childhood experience, we were all shaped in a different way. So what I would tolerate might not be something somebody else tolerates. And what somebody else tolerates, which is possibly, a potential zero in the portfolio and a bankruptcy, and they feel comfortable and they know what they're doing, I don't want to share the experience, right? So you choose your own place in this very wide range of what investing can be to you.
Yeah. So in that sense, I think because you did say Peter Lynch has played a huge role in your philosophy. And a large part of it is also, buying good companies, but also structuring your portfolio
Hmm.
in a manner that's suitable to you. So for you, do you categorize stocks into different groups, as Peter Lynch did, his cyclicals, his fast growers, etc., and then balance it according to that, and remain highly diversified like him, or do you tend to be more concentrated? And is that growing on you, the approach of concentration?
So it's a great question.